It's nearly the end of the financial year, which means it's been 12 months since I started a fresh new Trading 212 account. So I thought it'd be fun today to take a look at how my investments have performed so we can all have a laugh at me. Let's go.
Nobody knows if the stock is going to go up, down, sideways, or in
funds. They make up the majority of what I invest in, and that will likely always be the case. Because to be blunt, the professionals en masse fail to beat index funds long term. And they have all the tools and experience in the world at their fingertips.
Active fund managers consistently underperform the market.
So the idea that little old me sat here in my spare bedroom with my cat clawing at the door somehow got the jump on the professionals and can beat the market consistently is laughable. Haha. But that doesn't stop me from trying, does it? So of course, I buy some individual companies. I then enjoy watching them collapse and burn in front of my very eyes. All jokes aside, I'm making this video because I sit here week in, week out saying, don't worry about the market and whatever it's doing. Your portfolio's on fire. It's okay. We don't need no water. Let the mother trucker burn. Burn, mother, burn! But actions speak louder than words. So today I want to demonstrate that currently I'm right here next to you suffering in this volatile and unpredictable market. It goes without saying, but nothing I discuss today should be seen as financial advice. I normally stay away from these kind of videos because I don't want to be seen promoting stocks. The main thing is I'm not a financial advisor. I can't give you any form of financial advice tailored to your circumstances. This is me simply saying, I like these businesses long term and I think that they're good businesses, but I'm more than comfortable with being wrong with that decision as the investments in these businesses only makes up a small proportion of what I invest on a monthly basis. Since April 2021, which was the start of the tax year, when I opened this account, I've invested into Trading 212 £14,685.11p. At the time of recording this, that now sits at £13,219.43. But honestly, that figure's all over the place at the minute, so some of the print screens I display on screen might be slightly different to what I say, because as I record this, by the time I've edited it, it wouldn't surprise me if I've been slapped for another 10% in my portfolio. But as of the time of recording this, I'm currently down about £1,447.78p on my portfolio, just under 10%, which is pretty bad.
Now I'm panicking.
But honestly, I'm not worried in the slightest about that.
No, I am.
My largest holding is the Vanguard FTSE All World, or VWRL, where I've invested around £9,500 since April, and I'm currently down 5.65% or 530 quid. I'm not going to harp on about the benefits of a globally diversified portfolio in this video, but I think the recent events...
A deadly war has broken out in Europe.
COVID-19.
Global supply chain crisis
have highlighted the fact that we now live in a global economy where actions in the East affect countries in the West.
Back here at home, stocks fell sharply on Wall Street today as oil and gas prices continue to skyrocket.
And there's really no escaping the globalization effect on a portfolio.
Geopolitically, things are really hard.
So with everything that's going on in the world, it's unsurprising that this globally focused portfolio is currently down. I'll continue to invest consistently into a similar type of investment each month until the day comes that I need that money to live off. In fact, my portfolio with Vanguard, who I hold funds with, and the one that I have with HL, which is where I started my investing journey, both are invested into low-cost, globally diversified index funds. Right, that's the boring stuff out of the way. Now let's look at the cluster fudge that is the rest of it. With any business I buy, I like to think that I understand that business, and I could give an elevator pitch to anyone I speak to as to why I'm invested in that business. So I'll give you the same elevator pitch. I'm also going to give some examples of companies I've changed my mind about so you can see my thought process there, and ones that I was just flat out wrong about. I'm not going to discuss every position in my portfolio, as some of them I've recently purchased into, buying a dip as such. Tesla, Fiverr are examples of that. Let's start with my largest position outside of my world fund, Alphabet, aka Google. I've invested around £740 into Google in the last 12 months, and I'm currently down about 1.43%. But that's been helped massively by the FX impact, or the currency conversion rate, swinging in my favour. So in reality, I'm actually down around 5% on the investment. I've been dollar cost averaging into Alphabet since around June 2021. So why do I like Alphabet or Google? Well, first things first, they have a formidable moat.
What we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle.
A moat stops people from getting into a castle, and in business, a moat stops would-be competitors from taking market share away from a business. Google's moat is their complete dominance of search. So much so that Google is a verb. You don't search for something online, you Google it. How many other businesses can you name that have that kind of grip on their market? They control 84.2% of the desktop search market, and Google's search-based ads, the way they make most of their money, might just be the best business model ever made. Google targets us with ads based on what we search for, which is a dream for advertisers, who can target people actively looking for their products, and it doesn't feel as creepy as, say, Facebook.
Let me say this.
Who scoop up your data from all over the internet by literally following your every move and then target you with products based on your so-called interests. Now, Facebook has seen that ability to harvest data reduced by Apple's iOS transparency update, costing them a reported $10 billion a year. Now, that isn't a problem for Google. They've actually announced they're going to do something similar on Android devices, further kicking Facebook while they're down. If you want to join in the party, give Facebook a kick in while they're down, and stop them from harvesting all of your data from all over the internet, that's where today's video sponsor comes in, NordVPN. Have you ever wondered why sketchy websites always seem to know that there's hot singles in your area? Have you ever considered that every time you log onto a banking app whilst connected to a train's public Wi-Fi, you're exposing your details to anyone who knows how to look for them? The sexy singles and shady station swindlers can do this because they can see your IP address. And this is where NordVPN comes in. A bit like Cobweb is right now, they act as a middleman, sitting between you and the internet, hiding your IP address and protecting your information from anyone who would look to steal it or use it against you. The obvious benefit there is stopping people looking to steal your information, but it also allows you to access restricted content. Like if you wanted to watch any of these titles on Netflix in the UK, you just flip your NordVPN onto an American server and hey presto, you'll be watching Starship Troopers Traitors on Mars in no time at all. Awful movie, don't do it to yourself. He's had enough now. So there's a link down below, or you can go to nordvpn.com/DamienTalksMoney to get a big discount on their 2-year plan, as well as 1 month free. And the best thing of all is it's completely risk-free, because if you don't like it, they offer a 30-day money-back guarantee. Thank you, Nord, for sponsoring the video, and thank you, Cobweb. Okay, now back to the video. So as well as Google, in the Alphabet family, we have YouTube. To say I love YouTube is a bit of an understatement. I think it's one of the greatest resources for human expression and learning ever created. But I do think it faces a bit of a crisis at the minute, or a threat from TikTok, which is kind of just sucking up all the attention at the moment. But regardless of this, I think the real loser here is traditional media or normal TV. And I don't really see the trend slowing down. As YouTube and TikTok and these platforms become more popular, advertising spend will shift away from traditional media into the hands of companies like Alphabet, who control YouTube. Finally, I don't typically like to focus on the short term, but I also think it's worth mentioning that Alphabet, Google's parent company, have announced a stock split of 20-to-1 which will kick in July. And honestly, I think it's just an attempt to make the share price look cheaper on paper so it's more attractive to investors, which makes no real sense in a world of fractional shares. I guess maybe certain options traders might find it more attractive to trade options on Google if the price is cheaper. I don't know. But other tech companies have done this to great effect, namely, say, Tesla. When they did a stock split, the price went mental afterwards. And it does seem that if a company does a stock split and the per share price is cheaper on paper, people seem to be more inclined to buy that, even if the market capitalization has stayed the same. Now, the concerns I have for Google, and there are a few. The big one is regulation. Google uses its dominant position to benefit itself, and we've seen a number of fines in certain countries as a result of this. One example is the high-profile antitrust case they had in the EU.
You naughty, naughty.
Also, I see them being threatened by apps. Advertising revenue from desktop search is where Google gets most of its revenue from. And what that relies on is people sat at their desktops searching for things on Google. But with the rise of mobile phones comes a rise in apps as well. And every time someone interacts with an app to buy something, that's a missed opportunity for Google to generate some revenue from advertisers. Now, that might require them to diversify away from desktop search in order to bolster up their revenues from other sources. And they are trying to do this with YouTube and cloud-based services as well. But on the diversification point, search, YouTube, and cloud make up the majority of the business. The rest of the revenue they generate is from highly speculative, almost like game-changing technology gambles. X Developments, their research arm, literally calls itself the Moonshot Factory. Could obsession with changing the world suck up a load of revenue and not really produce much? Their research and development costs have risen year on year, but their core business of search-based ads and cloud revenue remains the same. But to be fair, Alphabet's increase in R&D spend is in line with increases in revenue. And it's really nice to see a business push the boundaries and try and change the world, but there is a risk here that all that money, all that spend, could result in sweet cool. However much money it costs them to develop that little pronunciation thing.
Bargain.
Look, I'm building a business on Google products. This video has been uploaded to YouTube, I scripted it on a Google Doc, and all of that is backed up to the Google Cloud. All I'm trying to say is I'm sipping on the Google Kool-Aid. So take what I say with a pinch of salt. I'm going to continue to dollar cost average into Alphabet, leading up to the stock split, and then kind of see what the price does from there. Right, the next business I'm going to talk about is AMD. I started buying AMD as soon as the financial year began, and have consistently been dipping in across the whole year. My interest was first piqued when I built a gaming computer to edit on. This one right here. It's nothing special, but what surprised me at the time was that AMD's products were cheaper and better than their competitors. As well as that, there was a shortage of their products because global demand was increasing so much, spurred on by the emergence of new industries. Like crypto, cloud computing and electric cars. I mean, I bet one day there'll even be a semiconductor in your milk carton.
It's got a computer chip in it. Everything does.
Now, the value of AMD has been clipped this year as they've been caught up in the overall tech stock decline, and there is also expectations that the personal computer market will slow down, affecting their sales. There's also a risk here that this is a fast-evolving, highly competitive space, and a competitor of AMD's could innovate and then dominate going forwards. AMD lived in the shadows of Intel for a long time. Now the tables are turning. That could happen again. A smarter play here might have been to just buy an ETF that tracks the semiconductor industry, rather than having my eggs all in one basket. For example, you could look at the VanEck Vectors Semiconductor UCI TS ETF. It holds 25 different semiconductor businesses, limits the size of any holdings to 10% so you don't get an overweighting anywhere, and allows you to bet on the semiconductor market trend without the overexposure to one company. The issue is there's a fee of 0.35%, which I would say is on the high side for an ETF. You could always just set up an investing pie with the likes of 212 or whoever your broker is and replicate the ETF without the fees. Now, another business I want to talk about is Affirm. I was pretty excited when I heard this business was coming to market. Good leadership with a founder who was part of the PayPal mafia, an exciting, rapidly growing sector in buy now, pay later, and Affirm in particular was doubling its revenues year on year. I was there on IPO day ready to potentially pile in, but as is so often the case with IPOs, the price just shot up and went way beyond what I thought it was worth. But you know, I had a sneaking suspicion that the price might come down because, as is so common with IPOs, once the excitement settles, the price kind of crashes afterwards. It fell away from $126 at the peak, and I was waiting for the dust to settle and started averaging in at a price of around $77. And just as I started buying, the price exploded off the back of them announcing a partnership with Amazon. From $77 to $167 in a matter of days. It's frustrating really because I knew that price action was only really being driven by the news, and I'd only had time to build up a small position at that point. If in normal circumstances I had a larger position and it had shot up that much that quickly, I would have sold out. But because I had such a small position, I just kind of left it, knowing though that the price action had been driven by hype. Now the reason I mention this is that the price has collapsed again recently, actually under my average purchase price. Now, the common logic might be, you know, to pile in and buy the dip, but what's important here is to understand why the price has collapsed recently and why buying the dip might actually be a terrible idea in this circumstance. While Affirm have announced excellent clients like Amazon and Shopify, a lot of their revenue was coming from Peloton, and we know how that's gone recently. And their losses, I mean, wow, their losses, holy
shish kebab.
In the final quarter of 2021, they lost $196 million in 3 months. That is up from $26.8 million the previous year. Now, a lot of those costs are down as marketing costs. Their marketing budget in the final quarter of 2021 was up $100 million on the year previous, and that only produced a top-line revenue increase of $160 million. They spent an extra $100 million on marketing and only produced an extra revenue of $160 million. Now, the average Affirm customer tends to use them 2.5 times, so we might not see the benefit of that marketing spend until later quarters. But with them burning that amount of cash and it not really looking like it's going to slow down anytime soon, they are likely to need to raise money. And that could come in the form of share dilution. For that reason, I'm not going to pile back in here. These widening losses and the business's need for lots more cash in order to survive has changed the outlook for me. I think those two factors are going to provide quite a lot of downward pressure on the share price, stopping it from rising back up to the heights it was at. I mean, I might be wrong, it might rocket again, who knows? So investing in high growth tech stocks has been a bit of a mixed bag for me this year. And with inflation kicking everyone's butts and then the very real threat of interest rates rising, I thought, why don't I look at some traditional value plays and increase my positions in UK banks like Barclays, and then I've also got Bank of America as well. So I started buying more into the banks on the basis that in a high interest rate environment, banks tend to do well. And then Barclays announced this. I mean, look at that. Profit soars. Barclays are down 20% this month. The troubles we're seeing play out at the moment are weighing heavy on banks as a result of the Russian banks being cut out of the SWIFT system, affecting the flow of money globally and also the wider economy.
And it's having a ripple effect across the globe.
My exacerbation at my losses over the course of this year is really only meant for entertainment purposes. In reality, the name of the game is buying good quality businesses that you think can increase their profits long term. And I think I'm doing that. And if I'm wrong, it doesn't really matter because there's my global index fund that I've got in the background. And if that doesn't work, well, there's always the crypto I've got.
Bitcoin is going to zero.
I just hope you take some reassurance from this that everyone is having a tough time recently. And really, the performance of my portfolio over the last year doesn't bother me one little bit because I've been investing for a while. But for those of us who are new to investing, the question at the minute really is, should I be starting now? Is now really a good time to start investing with everything that's going on in the world? That's why you should watch this video next, where I answer that question for you. And for everyone else,
goodbye.